Is your practice tired of wrestling with insurance denials, deciphering EOBs, and watching your revenue slip through the cracks? You are not alone. Welcome to The Claim Game, the podcast designed to cut through the confusion and provide you with the best practices for revenue cycle management success. We are Jeremy and Catherine Zug, and we've been with people just like you in the trenches. Each week, we'll break down complex billing processes, share real-world solutions from practices like yours, and ask questions of the game makers and changers of healthcare so you can take control of your revenue. Let's turn those claim denials into deposits and help you return to focusing on patient care. It's time to win the claim game.
Hey everyone, welcome back to the Claim Game at the Practice Solutions Studio. I'm Jeremy Zug and I'm your host for today. Normally I'm here with my wife, Catherine, but she is on maternity leave, so that's a good thing. As a reminder, in this season of the Claim Game, we're going through revenue cycle management best practices. We are analogizing revenue cycle management with a game board, hence our name, the Claim Game. And we're going through these best practices one board territory at a time. The last time we spoke here, we discussed denied claims and we walked through the exact steps you need to go through to record denials, understand them, and buckle up, make progress in resolving them. Remember, we want to keep in mind that these are your key territories for your practice, and mastering each one is crucial for victory and long-term success for your practice. Today, we're going to be grabbing a magnifying glass to zoom in on each of the spaces within these billing domains. We're going to reveal winning strategies to navigate the board with ease and confidence, ultimately claiming victory for your practice's bottom line. Quick reminder, if you missed the initial setup and want to understand the full scope of the board and how the 6 domains of billing work together, be sure to check out episode 1 for the complete overview. So now we're going to focus our attention on the current territory, which is payment posting. And we're going to be talking about allowed amounts and your fee schedule. This is a space where you get paid, but here's the kicker. The amount you get paid is rarely the amount you ask for. So I want to start with a conversation I had recently with a practice owner. Let's call her Sarah, for example. She's an incredible clinician, but she was really frustrated on our phone call. She said, Jeremy, I set my rate for $180. I sent the claim in to the insurance company, and they sent me a check for $112.50. Why even bother asking for the $180? And this is a fundamental friction point in insurance billing. And to win this particular game, I suppose, providers, you have to distinguish between 2 critical numbers. And I'm going to walk you through the difference between the sticker price on the claim you send and what you actually receive in payment. So let's walk through this. You have to separate these 2 concepts to understand your revenue. First, you have your billed amount. This is a sticker price. This is what you say your time is worth. If somebody walked in off the street and paid your cash rate not using insurance, it's like a menu price at a restaurant. But then you have something called an allowed amount. I like to think of the allowed amount as sort of like a club member price. When you signed your contract to be in network, you effectively joined the insurance company's club and you're agreeing to a discount from your cash rate for their members, right? That contract says we agree to pay in-network rates, but in exchange, you agree to accept our price for those services. So that rate, in Sarah's case, the $112.50 rate, is the allowed amount. That is the ceiling. It doesn't matter if your sticker price is $200. It doesn't matter if your sticker price is $500. It doesn't matter if the sticker price is $2,000. If the contract says the service that you build, CPT code, diagnosis code, all in, if that service is only worth $112 or what have you, that's what you get, plus the copay and deductible, whatever the cost share is, if that applies. So that all makes sense in practice and in theory, but this leads to an immediate question about the leftover money. What happens to the gap between the $180 and the $112.50 in Sarah's case? That gap is called the contractual adjustment or the write-off. This is not a tax thing. I know we share some terms. The revenue cycle management world and the accounting world share some similar terms. I promise this is not the same term. If you look at your explanation of benefits or your electronic remittance advice, you'll usually see this particular write-off marked with a group code CO-something, which stands for contractual obligation. Here's the golden rule here. You cannot bill your client, your patient, for that difference. Because you have an in-network contract with the insurance company, you're obligated to write that particular amount off. You just have to let it go. If you try to collect, in Sarah's case, the $67.50 from the patient, that's called balance billing. And that's sort of like a fast track way to get kicked out of a network or have to pay reparations to a patient or an insurance company. You do not want to do that. So if we're obligated to write it off, I hear this strategy question all the time. If the insurance company is only ever going to pay the $112.50, why don't I just change my prices to, you got it, $112.50? Why bother with the math? Now that sounds logical, right? But we've called this a trap before, and it's absolutely a trap. It brings us to the most important mechanic of this episode, which is the lesser of two rule. The insurance company's computer system is programmed to pay the lesser of two numbers: the allowed amount, which is their internal fee schedule, and your billed amount, your price. So here's how the little trap works. And this is one of those like back of the napkin type games that insurance companies play all the time. And we catch quite a bit of the time with folks that we work with in any of the ways you can work with us, but particularly in billing. Our billers catch this quite a bit. The allowed amount, let's call this scenario A. The allowed amount is $112.50. You bill $180. The computer goes beep, 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 boop. $112.50 is lower. You get paid the $112.50. You're following me? You're tracking? Scenario B, you decide that you're going to be quote unquote efficient. You lower your price to match what they're paying you. You bill $112.50. You get paid $112.50. So far, it looks the same. So why does this matter? It matters when January 1st rolls around, or July, for example, for some insurance companies, and they adjust their rates. Now, when I was billing in Chicago for a group practice there, I think it was either June or July, the biggest payer for the practice would alter their reimbursement rates, and it almost always went up. And I remember the first year this happened, the rates went up and I was pumped. I was like, let's go. We have a raise. It sounds good. And I had to learn what that meant. Let's say they've just adjusted their rate, and now the rate is $115. But what you're doing is you're still billing the $112.50, $112.50. So guess what happens? The computer looks at the two numbers. Your $112.50 is now the lesser number. So you You got it. Get paid $112.50. You just let go of $2.50 purely because you did not ask for it. This is a critical insight that you're capping your own revenue without realizing it. So, to avoid this, and we've used this analogy of a bucket before, think of your billed amount like a bucket. You want that bucket to be big enough to catch all the water the insurance company is willing to pour. If your bucket is too small, the extra water, the extra revenue spills over the side and is lost forever. And that $2.50, you might think, well, that's not very much, Jeremy. But if you're in a practice, like a group practice or a physician group, and you're doing 4,000 claims a month or more, that $2.50 is now a material difference between what you're billing and what you're getting paid versus what you could be paid. So the question is that you're probably wondering, how big should the bucket be? Is there a standard multiplier you recommend? Now, you don't want to be unreasonable, right? But from a strategy perspective, we generally recommend setting your fee schedule at roughly 150% to 200% of the Medicare rate in your area. And here's why. Medicare usually represents the basement floor for rates, the bargain bucket, the Salvation Army bargain bin of rates. If you set your fees well above that, you ensure that you aren't undercutting yourself on your better paying commercial contracts. The other option that you have available to you is you can find your largest payer and increase your rate by 20 to 30% of that rate above. And so you always stay ahead of the curve. And every time they raise their rate, you raise yours. This episode is brought to you by Jane, a practice management software and EMR built to support you in the day-to-day work of running your practice. If you're a health or wellness practitioner, you already know the care you provide starts well before your client arrives and extends far beyond the treatment room. Jane is there to support you in every part of that experience. With online booking, your clients can book at a time that works for them. And with features like notifications, they'll even be able to grab last-minute openings when they pop up. It's an easy way to keep your schedule full while getting your clients the care they need. During your appointment, Jane's AI-powered documentation feature can help you thoughtfully take notes so you can stay present with the person in front of you. And after appointments, you can end your time together on a healing note, not a transactional one, by charging the card on file. To learn more about how Jane can support you and your clients, head to jane.app/demo. And one last thing, if you're ready to get started with Jane, you can use my code in the show notes for a 1-month grace period on your new account. All right, so the strategy is to set fees high to capture full value, but this assumes we know what the quote-unquote water level actually is. So Sarah, let's say, going back to our example, our practice owner friend logs into her portal and she can't find a list. It feels like the payers are hiding this information on purpose. And it definitely feels that way sometimes. But you can't play this game blind. You need to know what your allowed amounts are to forecast your cash flow. So there are three primary ways that you find this data. First is the portal hunt. You log into your provider portal, could be Availity, could be a payer-specific portal, and you don't just look for fee schedule, you look for tools labeled claims research or fee schedule lookup. Often you have to enter your NPI, the date, and the specific CPT code to get the rate. The second way is the direct ask. You call up, boop, 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 call provider relations, but be prepared. They're not going to email you a spreadsheet. You have to say, I need to verify the current allowed amount for CPT code XYZ for my contract. Now, we have to give the firm, hard, fast maybe on the spreadsheet comment that I just made, because sometimes some insurance companies will send a spreadsheet because each insurance company is different state by state. So you want to take a look at that moving forward. But there is a third way that you can get rates. And the third way is our favorite because it's the most accurate. It's really kind of a history lesson. And there's actually another way that we're going to get there in a minute. But here's the history lesson. You go back through the last 5 paid claims for different patients, and you look for a column in your ERA or EOB that says allowed amount. That number is not theoretical. That's exactly what they paid you. And this brings up a massive point about organization. A clinician, if a practice owner does this research, it can get messy fast. So in the Hourglass Learning Hub, our member hub, we have tools that can help you organize this. And one tool that we actually just released in January is our new rate comparison tool. And I want to talk about why this particular tool is a game changer for your practice. The rate comparison tool is fantastic for visualizing your bucket compared to the buckets, the allowed amounts for each payer for, let's say, other practices in your area. Or let's say there's a big data aggregator, an MSO, that is acting as a large, mega, giant group practice, and you want to know what the insurance companies are paying those folks. That rate comparison tool pulls the transparency data from each insurance company, does the heavy lifting for you, and it shows you what your allowed amount is relative to the allowed amounts of companies in your area. So now you have some benchmarking information. And let me tell you something. I did some preliminary research on our own tool and was shocked by the disparity between what, let's say, small independent practice gets paid for, let's say, a service, and what a bigger organization is getting paid for the exact same service. We're not talking about $2.50. It is giant. And so you can use that information not just to guess what the rates are, but you can know beyond a shadow of a doubt how big your bucket is, and potentially, perhaps even negotiate an even bigger bucket now that you have that benchmarking data. Again, the link for that is below. Take a look. It's fascinating to see. All right, we've done the heavy lifting for you. You've walked through, these two concepts between allowed amount and billed amount. And now we're going to take a look at some real data, not just guesses. This is huge for reducing financial anxiety. And we want to move to the next step. You've set the rates, you've submitted the claims, and now we need to track what's coming in. And again, in the Hourglass, you can find our claim management spreadsheet. And here's how we think you should use that. That spreadsheet is like a daily dashboard. Most electronic health records their reports are a little clunky. The claim management spreadsheet allows you to look claim by claim, clinician by clinician, payer by payer, and see what has actually come in and where the claims are in process. The real value is that it highlights what hasn't been paid, and it stops claims from slipping through the cracks. If a claim is 45 days old and unpaid, this tool makes it stick out so that you can take action before it's too late. It's not about letting money disappear. We finally have an actual arrival of the payment. So you get the EOB, you get the full codes. We also created the payment posting guide for this. And why is that specific skill, posting payments, so critical? It's because if you don't understand how to do that, you can't predict how you're going to get paid in the future. The payment posting guide breaks down how to read an EOB and explain these codes that we discussed earlier. And if you post these incorrectly, your patient balances could be wrong, your allowed amounts could be wrong. You might bill a patient for money they didn't owe or fail to collect a deductible they do owe. That guide gives you a step-by-step workflow to ensure your billing is accurate. This can really turn into a chaotic situation if you don't have clear checklists. So what's one thing that you can check right now within your billing to add some value? Here's what we want you to do. I want you to pull up your top 3 most used CPT codes and compare what you're billing today against what you were paid on your last 3 explanation of benefits, your last 3 payments for that payer. If your billed amount is within $10 of your allowed amount, you are paying too close to the edge. You are one fee schedule update away from losing money, and we think you need to raise your rates. Now, you might be raising rates for your cash pay folks. That might be okay, especially if you're cutting it that thin between your allowed amount and your billed amount. So that's a clear, actionable thing you can do right now to help your billing. If you need help tracking this, or if you want to use the rate comparison tool, the claim management spreadsheet, or the payment posting guide, check out the resources we have in the Hourglass Learning Hub. Our Learning Hub is becoming the place that practice owners and billers are going to get real-life strategy, real-life tools, downloadable tactics and strategies and scripts for running their billing. Knowing the difference between your billed amount and allowed amount is the difference between capping your revenue and maximizing it. Next time on the Claim Game, we're going to be discussing our next territory. You won't want to miss it. Can't wait to see you there. Thank you so much for allowing us into your ears. We will see you next time on the Claim Game. If you enjoyed today's episode of the Claim Game, please take a moment to leave us a rating and review wherever you listen to your podcasts. It really helps new listeners to find us. Make sure you never miss an episode by subscribing to the Claim Game on your favorite podcast app. Your feedback means so much to us. We want to provide valuable education about revenue cycle management. So if there's something we didn't cover in our topic that was a burning question for you, please let us know so we can try to get you the information you desire. You can find the links to all resources we mentioned in this episode in the show notes. And if you want to dive deeper into our resources, we have two places you can do that. First, you can go to our blog at practicesol.com/blog, where we have 8 years of educational blogs. If you want to learn more about what Practice Solutions does, reach out. We'd love to hear from you. Just go to practicesol.com to learn more and to connect with one of our awesome people on our team. Thanks for listening. We are Jeremy and Catherine Zug, and this is The Claim Game. See you at the game table next time.